So what is the best gift that you can get your child? It's an index universal life policy. It's financial security, and it is more than just college savings. What traditionally right now people are saving just for their kids' college or whatever, and that's pretty much all it will pay for. But using that same money combined or actually inside of one of these products and structured the way that we will have you, structure it, you're able to pay for their college or make sure that their college is paid for, they're gaining income during their retirement, and they're able to leave money or leave a legacy for their kids when they pass away. Let me show you how. Our studies, and when I say study, I mean a Google search, shows that parents spend or save an average of $7,800 a year in 529 college savings plans or otherwise for their children's college. And what we're going to show you is what you can do with that $7,800, or how you can save it, that's going to really yield a much better result for your children. And we're also going to go into some of the pros and cons and comparisons of the 529. But right now, I really want to just dive into the IUL, Index Universal Life. The 529, not only does it have all of these restrictions, it also doesn't have all of the wonderful abilities that an IUL has. So with the IUL, there is a cash accumulation portion of it. So that's going to be your savings portion of it. But again, you still have your comprehensive insurance. And as we go through this IUL, you're going to see how all of that comes together. Now, we're going to start the policy paying $7,800 a month, okay? And that gives you a death benefit, an initial death benefit of $545,620. So that means after your first initial premium payment of $650, that's assuming you're doing this $7,800 a year, in 12 monthly premiums of $650. So after your initial premium payment, you have that death benefit, okay? $545,620 available if, God forbid, of course, your child dies. In addition to the death benefit, of course, your IUL comes with living benefits, okay? And that's an accelerated benefits rider that will cover terminal illness, chronic illness, critical injury, critical illness, Alzheimer's disease. Of course, nobody anticipates their kids having Alzheimer's disease, but this is a policy. We're going to show you how to keep it going for the rest of your child's life, right? And even more. But again, from day one, you have all of those benefits. So let's get into the money. The amazing thing about IULs, right, is that, again, it has a cash accumulation, and it grows with the market, or it grows along with the market, the indices in the market. And it has a floor. So if there is a downturn, you are completely protected from any loss. In addition, the way that it works is that you are able to take loans from your cash accumulation, which is also how we structure any income payments. Now, the way the IRS treats life insurance, so long as you're not just canceling your plan, right, and taking out all of the money in your plan and you're taking it out as a loan against your policy, that comes out completely income tax free. And let's go down to the tables. All right, so as you're going to see, you're putting in $7,800 a year for 18 years. Okay, so this is just day one from when you have your kid until they turn 18. You'll see the total amount that you put in over those 18 years is going to be $140,400. All right, and again, from day one, you have this death benefit of $545,446. Another thing I want you to notice here are these two columns that will show you different interest rates, okay? This first column here shows you 3% interest, which is really very low. And then the current illustrated values shows you 6.44, which again is very, very conservative. Again, we are regulated by law, so as not to illustrate or show you illustrations that are giving you, very high returns. We have to show you these conservative returns of 6.44. So you're going to see at the end of year 18, right, your total cash accumulation here is $237,497. That's $237,497. Okay, from that $140,400 put in there, you now have $237,497. And in addition to that, the death benefit is $775,800. Okay, so now at this point in time, because you have these funds, right, you can go into your child's IUL and borrow against it in order to fund their college education. Or certainly a very hefty amount right there left for you to put towards their college education. Or let's say your child has a scholarship, or you figured out college in another aspect. A couple things I'm going to show you is, one, how this policy is, intended and can play out for your child, assuming that you don't need any of this money, right, for college. And then the other thing that I want to show you is what we would do, right? And this is really exciting because we have something that we like to think of as a 5-year retirement plan, or an IUL on steroids. That is very exciting. But first, let's assume you do not need any of this money at this point, or at when your kid turns 18 for college, because it's going to be funded some other way, right? You will maintain this plan, and then at age 65, you can start income, or your child can start income without adding another penny, by the way, okay? So now this is a fully funded plan, and during retirement years, if we go down here, and assuming, of course, that the market is doing at least that conservative amount of 6.44, your child is going to be able to receive $424,762 a year from the age of 65 until the day they die. That is their entire retirement, all retirement years. They're going to be receiving almost $500,000 until they die. It will not run out, and they will be all set in their retirement years, assuming that these funds are not used, of course, for college. This assumes that this IUL is going to just continue the way that it's been illustrated. Thank you, everybody. I hope that was very informative. And if you didn't learn anything else besides you need to get in contact with us now, learn that right now. You need to get into contact with us now because time matters for this. Your kids matter, their future matters, and the sooner you do it, the more money can grow, the more time your money has to work for you. Bye.